right. Good morning, everybody. Good morning and happy Tuesday, everybody. Today is November 21st, 2023. Top stories this morning. We got a whole bunch of retailers reporting their quarterly earnings, and most of them with an asterisk, were not good at all. Same store sales down at most of these guys, stocks down at most of these guys. And the story is something we've heard on this channel before, that American consumers are slowing down their spending, that after years and years of the cost of inflation eating away at consumer savings, devaluing the wages that they earn, there's just less money at the end of the month to go buy other things. Your rent has gone up, your car payment has gone up, your electric bill, your food, your grocery, everything has gone up. It's still going up for most of them, although it's going up much slower now than it had been going up, but it is still going up in most cases. And so people just don't have money to spend at other stores after they meet their necessities. A couple of silver linings within that dark cloud, though. For whatever reason, Abercrombie and Fitch posted a phenomenal quarter, significant same-store sales growth, although that stock is getting crushed because it's tripled this year. So, I guess you got a little bit of selling the news going on over at Abercrombie and Fitch. Also, Dick's Sporting Goods posted a decent quarter, not great, but they saw some same-store sales growth. I guess that is the trend of people are spending more money on experiences, less money on stuff. And well, with Dick's, you're kind of in between there, right? Because that's the stuff that you need for the experiences. If you're buying sporting goods, that means maybe you're outside, you're playing baseball, you're playing tennis more. You got to go shopping at Dick's first. So there are some silver linings in there. It's not all doom and gloom. But for the most part, think about the retailers that we've seen in just the last couple of days here, or the last 2 weeks, we'll go back. Home Depot, Lowe's, both terrible same-store sales. Target and Walmart. Target was really bad. Walmart actually saw a little bit of market share, a little bit of gain, but their stock didn't do so good after their report because their forecast was light. Then today we got Best Buy, we got Kohls, we got American Eagle, all posting bad numbers, bad same-store sales numbers. So the consumer is struggling. And we're seeing that in the form of consumer credit. Also, an article in Market Watch today about consumers being rejected on credit applications at record rates. We're seeing auto loans get rejected at all-time highs. That data goes back to 2013. More people are being rejected for car loans now than at any point since we've been gathering that data since 2013. We've got more people are asking for credit card limit extensions. Please raise the limit on my credit card. Most notably, people with low credit scores are asking for credit limit extensions, and they're getting rejected, a lot of them. What does that say about future growth of the American consumer? What does that say about those strong consumer numbers that we got from the second quarter GDP? Or was that third quarter? That was third quarter GDP. What does it say about those consumer numbers that they're not going to be keeping up? We're also seeing inventories dropping at most of these retailers. They're not ordering new stuff to replace what they're selling. And remember, inventory growth shows up as GDP growth. We saw a lot of inventory growth in the third quarter numbers. That was stuff piling up on the shelves. That looks like economic growth in the way we measure GDP. But when those stores decide we're not going to replace the things we're selling, and so they start to attrit down that inventory as they sell it, well, now you've got inventory reductions. That looks like GDP contraction. And between the slowdown in retail spending and the phenomenon of retailers not replacing the stuff on their shelves, I think we're probably looking at some pretty lousy fourth quarter GDP numbers in just a few months here. And we're heading into Black Friday this week, guys. This is the big shopping season. And if these forecasts from these retailers are any indicator, it is not going to be a very good year for holiday shopping. Also, we got today, the yen is stronger again. It looks like people are starting to front run the Bank of Japan. This combination of the Bank of Japan trying to slowly ease out of their ultra dovish monetary policy of yield curve control, combined with this, in my opinion, misguided belief that the Fed is going to start cutting rates any day now. Those two things combined, you've got people starting to get out of the yen carry trade. They're starting to cover their short bets on the yen. And while that's driving the dollar lower and the yen higher, now this is just the beginning of a trend. The yen is still historically weak versus the dollar, and it's got a long way to go. So it's not time to cry panic about the unwind of the yen carry trade yet, but it does look like it has begun. We've also got some bad news out of EV makers. A lot of executives quitting in EV makers, non-Tesla EV makers, I would mention. Nikola, Fisker, not looking so good. Some suspicious resignations happening at those companies, and more stimmies out of China trying to save their beleaguered property developers. There's a lot going on today. Let's shrink my big melon of a head while we talk about this stuff. Don't forget that like button, guys. And if you're new to the channel, subscribe and have your coffee with the melon heads every morning. We do this every day. S&P is currently down 11 points ahead of the opening bell, 0.25% lower. Just want to show you guys a long-term chart of the S&P. This is going back to about August of last year. Just this monster rally the S&P had pretty much all spring and all summer. There's your AI mania. All right, we had this little, looks like a bull flag that we had in the fall, and then just this ridiculous monstrosity run. Look at how just straight up we've gone for about the last 2.5, almost 3 weeks now. We're coming up on this 4,600 level here, guys, where we topped out last time. Shout out to my buddy Mike Binder, who nailed that 4,600 top within about 5 points a few months ago. Are we going to challenge that level? We'll see. We've got NVIDIA earnings after the bell today. NVIDIA is basically the market darling of AI, something I've talked about at great length on this channel. I don't think NVIDIA's growth is organic. I think there's a lot of shenanigans going on at that company. You can see all those videos I did about CoreWeave if you want to know more about that. But they report today. I have every confidence that NVIDIA is going to report just phenomenal numbers. They almost always do. Whether these numbers are legitimate or not is the question. So after the hysteria wears off and after Meet Kevin is done glowing over how good NVIDIA's numbers were and blushing, oh my God, I have a Jensen Huang poster in his motorcycle jacket over my bed. After all that is done, we'll actually look into where NVIDIA sold their stuff and what actually happened and see, hey, maybe there's a story in there. But that's after the bell today, and that will pretty much set the direction of the market, I think, for the coming days as we approach that high from just a few weeks ago. Also, we got the Dow is down 44 points, 0.13% lower ahead of the opening bell. The NASDAQ down 74, almost 0.5% lower for the NASDAQ ahead of the open. So tech is not looking so good this morning. Gold futures, December gold futures back over 2,000. How about that one? Congratulations to the gold bulls. Up $20 this morning, 1% higher. I think that weaker dollar is playing a big role there, and those lower interest rates of the last few days. December silver futures at $23.90. That's up 28 cents. Looking to claw back that 24 handle in silver. Congratulations to the stackers there. 1.25% higher for silver. We've got platinum is up 1%. Palladium is down about 0.9%. And West Texas Intermediate January futures trading at 77.47. That's down about 35 cents this morning, or about 0.5%. Looking over at the bond market, we got a mixed bag this morning. Yields not really moving much in either direction. The 30-year is down up 0.5%, 4.58%. Yield on the 30-year. The 10 years yielding 4.414. That is down down 1 basis point, or 1/100th of 1%. Man, I'm mixed up this morning. And the 2-year 4.904, down about 1 point, with the 1 month pretty much unchanged at 5.397. Now looking at the Dixie, the US dollar is down 10 basis points this morning, 103.34. The dollar has had a rough couple of weeks. Most of this is being driven by the Japanese yen right now. The yen is really strengthening against the dollar. And you got to watch that one. Check out this story in Reuters from this morning. Yen jumps as dollar slips. Yen jumps and dollar slips as traders eye interest rate tweaks. And this is a big story, guys. It's the beginning of a big story. If this continues, this is going to be a very big story. The yen rallied against the dollar for a 4th straight session on Tuesday, as investors positioned for the possibility that the Bank of Japan will tighten monetary policy next week while the U.S. Federal Reserve loosens. There's a lot of excitement. Momentum is building, and the ability of the Bank of Japan to exit its ultra-loose monetary policy, possibly next year, ending negative interest rates, said Jane Foley, head of FX strategy at Rabobank. So there's a lot of excitement. People are talking about the Bank of Japan is going to start tightening and this ultra-loose policy. Foley said a sharp drop in the dollar was also encouraging investors to unwind some of their bets against the yen. The dollar is weaker, and this, I think, is just the catalyst for the market making bets on how far dollar yen can really move, she said. Now, this is the important paragraph here, guys. This is why you should care about a move in the yen. All right. The sharp drop in the dollar encouraging investors to unwind some of their bets against the yen. I've talked about this. I did an interview with Michael Gayet on my channel not too long ago about the unwinding of the yen carry trade. Now, we don't know how big the yen carry trade is, but it's been going on for years because it's been so cheap to borrow money in Japan. And because the Japanese yen has constantly been losing value against the dollar, you had a lot of American institutions and a lot of global institutions for that matter. They went over to Japan and they borrowed yen, and then they converted those yen into dollars or euros, and they bought assets with that money. They bought US stocks or maybe even European stocks. And they can make money on that because the US stocks have been going up and they pay dividends and there's yields. But the interest rate they're paying on that yen is very low. And as the yen weakens against the dollar, it gets easier to pay back that debt. That's called the yen carry trade. And you can make a lot of money harvesting the difference there. But if that trend reverses, if the Fed starts to loosen while the BOJ tightens, then you're going to get higher interest rates in Japan. It gets more expensive to borrow those yen, and the yen starts to strengthen against the dollar. So that trade very quickly reverses and all your gains go up in smoke. And so what do? You unwind the carry trade. You sell those US assets, convert those dollars back into yen, and you cover your short against the yen. Well, that act lowers the value of U.S. assets, it weakens the value of the dollar, and it further strengthens the yen, so it can turn into a feedback loop where it feeds on itself. Now, this is very early innings. I just want to add, guys, this is only just starting, and we've been here before, all right? The yen has weakened to levels seen in mid-September, so it's not like the yen has strengthened to levels in September. When you see this chart going down, that is the yen strengthening against the dollar. All right, so this move right here, it's not the biggest move in the yen, and it only takes us back to September. We saw something similar back in July. You see, we had this move right here. That reversed, and this trend continued. But if this actually is the start of the breakdown in the carry trade, then we could see the yen head much, much lower as people start to cover that short against the yen. That would be very bad for U.S. assets. So we'll keep an eye on that one. Watch that yen-USD trade. But there's the top story today that I wanted to talk about is the retailers, because there's a lot of retailers coming in today. Best Buy cuts sales forecast as holiday shoppers hunt for deals. Hunt for deals is a nice way of saying they're broke, guys. That's what they're saying. Best Buy cut its full-year sales outlook on Tuesday as the company weathers a period of cooler demand and prepares for price-conscious holiday shoppers. There's that weak demand. There's the bargain hunters, right? They're making it seem like suddenly American shoppers are so thrifty and such skillful consumers. No, we're idiots who rack up debt uncontrollably, and we've just run out of the ability to run up that debt. That's what's going on here. We didn't suddenly all become thrifty. We're broke. That's what's going on. Comparable sales, an industry metric that includes sales online and at stores open at least 14 months, fell by 6.9% year over year and 7.3% in the U.S. as shoppers bought fewer appliances, computers, home theaters, and mobile phones. The company said it did see sales growing in gaming, though. People are buying more video games. They're buying less of everything else at Best Buy. Same-store sales down 6.9%. That is terrible. Terrible metric for a retailer. The company's online sales also dropped 9.3%, even worse. So that's Best Buy. Terrible numbers from Best Buy. What do we get at Kohls? Kohls earnings look good, but sales are a different story. The stock is falling. And by the way, let me just say real quick, all of these companies beat earnings. Why? Because earnings expectations no longer mean anything. All of these analysts are worthless quacks who come in with lowball numbers that are artificially lowered just to make sure we get that headline of the stock beat earnings. It happens no matter how bad the quarter is. They always beat earnings estimates. Why? Because those estimates are worthless. Shout out to all you analysts who are setting artificially low expectations just to make these companies look better. You're not fooling anybody. It's a joke, guys. All right, but let's talk about what's going on. Kohls stock was pointing lower after the retailer flew past quarterly estimates, but saw sales decline. If sales are declining, how can you beat quarterly estimates? Because the quarterly estimates are bunk. That's how. Net sales of $3.843 billion missed analyst estimates of $3.988 billion. And the same-store sales fell 5.5% from a year earlier, worse than the expected 3.8% decline. So even Kohls down 3.8%, same store sales. It's the same store in the same place doing less business than it did a year ago. Guys, I would add a year ago, things were not looking very good either because people were struggling with inflation at the end of the fourth quarter last year. So Kohls, again, lousy numbers. American Eagle Outfitter stock falls sharply in pre-market trades. Now, I looked around in several articles about American Eagle Outfitters. I couldn't find comparable store sales or same store sales. Nobody mentioned anything. So I don't have the comps to report on this one. So I can just give you the headlines here. American Eagle's stock is down 16% in pre-market trading on Tuesday after the midpoint of the retailer's fourth quarter operating income forecast fell short of estimates. So I don't have the same store sales numbers to give you, but their forecast for the fourth quarter was lower than the market was expecting, and that stock is getting punished after hours. So American Eagle, lousy quarterly report. A lot of retailers reporting lousy numbers. Now let's talk about some retailers that are actually reporting decent numbers here. Abercrombie & Fitch earnings top estimates and retailer raises guidance, but stock still falls. Abercrombie & Fitch stock has more than tripled year to date, and so there's some profit taking going on this report. When a stock has already tripled, it's pretty hard to continue rallying on earnings after a stock has already done that. Maybe something you NVIDIA shareholders might want to keep in mind if you're thinking about piling in ahead of the earnings today. The same store sales at Abercrombie & Fitch rose. That's interesting. They're up 16% at Abercrombie & Fitch. Whoa. Net sales growth of 20% accelerated from the second quarter and was once again led by Abercrombie brands with exceptional growth of 30%. That's according to CEO Fran Horowitz. So Abercrombie & Fitch is the silver lining here, guys. Same store sales up 16%. Net sales up 20%. Growth of 30% at Abercrombie brands. So whatever is going on in the economy, whatever is happening to the American consumer, she is still shelling out for Abercrombie & Fitch. Take from that what you will, but it's not all bad news. And I know, guys, I don't usually do optimism and good news here. So, in the interest of posterity, I must report the good news as well. And speaking of good news, we actually got a decent report from Dick's. Dick's Sporting Goods reports third quarter results and raises full year outlook. 1.7% growth in same store sales at Dick's. Now, this makes sense to me again because one thing we've seen, especially with a lot of the spending on services, all of the inflation numbers in services have been higher. The consumer numbers in services were very good. Americans are spending more money on experiences than they are on stuff. And when it comes to Dick's Sporting Goods, well, this is the stuff you have to buy in order to have the experience. Tennis rackets, golf clubs, basketballs, right? If you're out doing activities, maybe you're shopping at Dick's. So I guess I can understand this 1.7% growth in comparable store sales at Dick's. Again, it's not all bad news. But let's talk a little bit about some of the trends in the economy around with these retailers. Now, this story is a couple of weeks old here in Bloomberg, but this is important. A slump in big purchases clashes with government's strong consumer data. Remember, in the last quarterly GDP report, we had some significant retail consumer spending, a lot of growth in the American consumers. And all of these quarterly reports, except for Abercrombie and Fitch and Dick's, all of these quarterly reports, Target, Walmart, Home Depot, Best Buy, Kohls, they're all terrible. So where did this number from the retail spending come from? From the consumer spending, maybe services, but they're definitely not buying stuff. But check this out. Sales of appliances, orthodontics, and boats weakens, firms say. U.S. needs Americans to keep up spending to avoid a recession. I can't help but notice the word orthodontics in here, guys. Sales of appliances, orthodontics, and boats weaken. All right, I get it. Boats, that's the quintessential luxury item. And when things get tight, you stop spending on your boat. That makes sense. Appliances, I'd like to have that new dishwasher, but things are tight at home, so I'm going to keep the old noisy one. Okay, I get that. Orthodontics? The kids aren't getting braces? We're still shopping at Abercrombie & Fitch. We're still buying golf clubs. But sorry, Timmy, you're going to have to wait for your braces. Got to keep your crooked teeth just a little bit longer. We got this inflation going on. I couldn't help but notice, my God, our priorities are so messed up. Anyways, The kids' braces are the last thing you cut, people. Get your priorities in order. Makers of refrigerators, boats, and teeth straighteners say U.S. consumers are shunning big-ticket items, defying the macroeconomic reports on spending. Shoppers think long and hard before buying a motorized vehicle or a washing machine, and they're increasingly reconsidering them. That's a bad sign for a U.S. economy that has been kept afloat and out of recession by the willingness of Americans to keep spending despite high inflation and interest rates. So besides the laughable comment there about orthodontics, here's the thing, the slump in big tickets that we need consumers to keep shopping, to keep spending, to stay out of a recession. Well, that may not be happening because we got this one just yesterday in Market Watch. A record share of people applying for auto loans were rejected this year, according to a New York Fed survey. Rejection rates for all kinds of loans climbed in 2023. Application rates dropped, according to the New York Fed survey on credit access. So here again, you've got the consumer is tapped, guys. You've got loans are getting rejected at a higher rate. You've got fewer applications to begin with. People are trying to borrow less all of a sudden. More people are getting rejected when they do try to borrow. And so what does that tell you about the direction that the American consumer is heading in? Let's just say would-be car buyers say lenders have been tapping the brakes hard in 2023, according to a new look at consumer access to credit. A record-breaking share of auto loan applicants say they've been rejected for loans this year, according to the Federal Reserve Bank of New York. Based on surveys collected in February, June, and October, an average of 11% of auto loan applicants said they had been rejected. That is the highest yearly car loan rejection rate since the New York Fed began tracking data in 2013. But it's not just car loans that are getting rejected, folks. Across the board, reported rejection rates for loans climbed while application rates dropped year to date. The report showed hints of households facing financial pressure. The share of people seeking to increase the limit on their credit card rose to 17.8% this year, up from 11.2% in October of 2022. Nearly one-third of those applicants, 32.1%, reported that they were turned away when requesting higher maximums. So remember that chart of $1 trillion in U.S. credit. Remember, I've been saying, yeah, Americans are still spending money, but they're putting it all on the credit card, and that's only going to last until the banks start cutting us off. The banks just started cutting us off. Nearly one-third of people requesting a higher credit limit have been rejected. And more people are requesting that higher limit than at any time before. The sharpest jumps in applications to increase credit card limits came from people with lower credit scores of 680 and below. So, of course, it is the poor who are being hurt the hardest by this. Americans amassed a $1.08 trillion in credit card debt through the third quarter, Fed researchers said earlier this month. I would add that mortgage application rejection rates decreased between 22 and 23, but mortgage application rates also fell. So you've got fewer people applying for a mortgage to even begin with. Why? Because they know they can't afford a home. So guys, the banks have started to cut us off. We're getting rejected for cars. We're getting rejected for credit cards. We're still trying to purchase things on the debt, although at a much lower rate than before. It's starting to show in all of these retailers. Watch out for those fourth quarter GDP numbers. And across the bond, I want to talk on this one real quick, guys. China property stocks surge with Sunak rallying 27% after Beijing picks 50 firms to fund. Long 4 and season notes are among the bonds which are rallying. JP Morgan says the white list won't prevent firms from defaulting. This is more stimmies out of China. Chinese developers' bonds gained along with their shares after authorities began drafting a list of 50 real estate firms that would be eligible for a range of financing as Beijing sought to support the embattled property sector. Now, guys, I got to tell you here, there's very little substance to this story. All right, all these bonds are rallying. Why? Because authorities began drafting a list. They have not published the list. They just began drafting it. All right. If I take out my notes here and I start making a list, I have begun drafting a list. It doesn't mean spit. It doesn't mean anything, guys. I just began drafting a list. And okay, the 50 real estate firms, arbitrary number chosen, 50 real estate firms, they'll be eligible for a range of financing. What is that financing and what is that range? No details anywhere in the article. but everybody's just rallying. Why? Because the Chinese government is saying we're going to stimmy up these companies. They're saying we're going to make sure they have all the money in the world. How much? Which companies? Nobody knows. Everybody's just rallying on the hopium that the Chinese government will bail out the property sector. They can't. It's the thing. They can't bail out the property sector. If people are not buying houses, no amount of stimmies can replace that. And right now in China, people are buying fewer houses and they're paying less for them. Property sector is hosed no matter what Beijing does. A Bloomberg gauge of China developer stocks, though, gained as much as 7.6% to head for its biggest advance since September. Sunac China Holdings Ltd., the first major Chinese builder to reach a restructuring agreement, led the sector's rise as it rallied as much as 27%. Seasoned Group and Agile Group also climbed. So more stimmies or more rumors of stimmies out of China. Again, it's not going to last. Let's talk about EVs for a second, because I saw two stories yesterday that were very suspicious to me, and they came in all within about the same couple of hours. EV startup Fisker has lost another chief accounting officer. The second executive in weeks resigns from the role as the automaker tries to increase sales. Now, guys, it was just a week ago, maybe it was 2 weeks ago now, that Fisker's chief accounting officer resigned, and Fisker announced that they had to delay their quarterly earnings report because their chief accounting officer had just quit. Well, the person they replaced with, they just quit too. So that's not a very good sign for Fisker here, all right? Electric vehicle startup Fisker has lost its second chief accounting officer in less than a month, the latest setback for a company that only recently started selling its first model. Floris Buting, who was named chief accounting officer in early November, has left the automaker, the company said in a regulatory filing on Monday. His exit follows the departure of his predecessor, who left in late October, after roughly 3 years at the startup to take a job with another company, leading Fisker to unexpectedly delay their quarterly earnings release. Buting resigned from the company Tuesday, a day after Fisker reported third quarter results, according to the filings. So I don't know what's going on at Fisker, but their CAO quits. They had to delay their quarterly earnings. So they bring in this other person to be the chief accounting officer. They report the earnings, and then a day later, he quits too. The books at this company are a mess. And when executives start bailing, start jumping ship, it's usually a sign that something pretty bad is about to happen. So keep your eye on Fisker, and also keep your eye on Nikola. This company has always been a joke. Remember the video of the truck, but it was actually being pulled by a gas-powered truck because the truck didn't work? Yeah, that was this company. Nikola's CFO resigns after 6 months in the role. Stacy Pasterik is the third senior leader to exit the electric truck maker in 3 months. We've got another EV maker with a whole bunch of more executives quitting. Nikola Corp's CFO, Stacy Pasterik, is leaving the role after just 6 months, the third senior leader to depart the beleaguered electric truck maker since August. CEO Michael Loscheller and Nikola president of Energy, Carrie Mendez, both quit in August. Again, CEOs, CFOs, all jumping ship. Something bad is happening in EVs, guys. You know me. I'm not going to go down my whole rant on EVs. I have always been a critic. But these companies are in trouble, and these guys are getting subsidies just handed to them by the boatload right now. Tax incentives, bribing consumers to buy their products, and they're still not profitable. Their books are a mess. Their executives are leaving. The vehicles are piling up at the car lots. What are we doing here, guys, with EVs? People don't want them. There, I said it. People just don't want them. Anyways, I want to say thank you very much to Mr. Mike M. Thank you, sir, for the super chat. He says, morning ING repo report, please. Oh, the repo. You mean the reverse repo. Let's see. What did reverse repo do yesterday? I remember I looked at it. Why is this not working? Here we go. Let's see. Let's bring up the reverse repo. Here I have the thing. Reverse repo was $953 billion yesterday. That was up a little bit from the 930 some odd billion that it was. Let me bring up my chart on TradingView. That has the trend line here. Let's see if we are still moving along that red line. Yep, we're just above the red line right now, Mike, but we are still on pace to hit that zero mark sometime in the middle of February. Reverse repo at $953 billion. That is up $17 billion from yesterday. So the drain continues, although it is still a somewhat slow drain. It's going to take a couple of months to get there. Thank you again, Mike. I appreciate the super chat and the support of the channel. And thank you, everybody, for spending your morning with the Melonheads. I appreciate you guys very much. Thank you to my Patreon supporters for everything you guys do for the channel. Link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Until next time, live small and dream big.